it's all about expectations. And there were some expectations that we would get a downward revision of 1 million jobs. Instead, we got 818,000. So this was, how would you characterize this revision?
I mean, there was a wide range of expectations, and some people, including us, expected a slightly less of a downward revision. It's really about what you make of this number as it applies to the forward trajectory of payrolls. It's not really about what happened in the past. It could be revised even further, to the upside included. So I think what is worrying here in that revision is that maybe there's like this kind of an error in the numbers that we will see included in the payrolls numbers going forward. So that's a risk here, right? So we still see decent payroll growth, but maybe it's not as good as the numbers are telling us. But having said that, if you look at the economy continues to grow. Yeah. We still get decent numbers on economic growth, consumption, and the signals from companies are that the consumers continue to spend. So I think that all in all, this is just telling us that, very strong, robust numbers that we saw last year were not as strong. Right. And we were all surprised when we were getting them anyway. So it gets the household survey with the establishment survey closer, and that's what I make out of it.
So the trajectory is not all that different, even if the numbers and the scale of the gains that we saw might be revised lower here. What does this mean in terms of how you're thinking about the August payrolls number? Right now, the consensus estimate is for 155,000 jobs. Are you revising that down based on what you saw with this revision?
Absolutely no impact on our projections for August payrolls. We think that we're going to see a rebound. We still think that despite what BLS said in the report, that there was no impact from the weather, there was some impact from the weather in that July report. So we may see some rebound here in August. But nonetheless, I think job growth is slowing regardless of what we saw in the revisions. You can see that in the more recent data, like jolts and openings and things like that. Yeah. But there are no layoffs to a big extent because claims are still pretty low.
But even if people aren't necessarily losing their jobs, Yelena, and I'm sure you know this as obviously being a much smarter on economics than me and Scarlett, is that it has sort of a psychological effect on a lot of folks. Those who are still employed, they're not going to spend the same. And there were a bunch of retailer earnings that came out this morning, and they all, while the reports were sort of different in nature, the common thread was that people are searching for value. They are much more budget conscious. I interviewed the CEO of Macy's earlier this morning, Tony Spring, and he really hit home with this idea here that basically they are seeing a customer that is much more discerning, and now they are retrenching the company itself to trying to find ways to accommodate this. And he sees a really rocky next few months ahead. And I'm just wondering, when you're hearing these type of comments out of the companies, even though it hasn't shown up in the official data, should we be worried?
We should be cautious and obviously watch the data very closely. I don't think that we are going to see a deterioration. We definitely are seeing some slowing, moderation, and the comments basically confirm that narrative. I think it's really about the different types of consumers, right? High-end income consumers are still spending. We still have this massive deleveraging that happened since the Great Recession. People can borrow, and they can borrow pretty easily if you have good credit and high income. And the wealth effect is still present. Look at home prices, look at equity markets. I think that kind of buffer will help us in terms of consumer spending, even though like a large group of consumers is probably struggling indeed with high prices.
Well, that gets to a tricky question here about what the Fed should be reacting to. So, because you're kind of describing a little bit of a tale of two cities here. Should the Fed's reaction function be on those aggregate numbers, basically just looking at the totality and then shifting rates accordingly? Or should they look at that bifurcation and then make adjustments based on that?
Well, that's why there are a lot of smart people who work at the Fed. And basically, yes, the mandate is unfortunately pretty blunt, right? You have to react to overall the totality of data. And that's why we expect them to start cutting rates in September. So they're ready. The minutes from the previous meeting told us that they were ready to start the cutting cycle, but the cutting cycle will be to reduce that unnecessary restriction in the economy, not trying to catch up falling knife.
Yelena, very quickly, I mentioned earlier on that these revisions were supposed to be released at 10 a.m. They weren't. It took about a half hour more, but you managed to get a hold of the numbers a little bit earlier than a lot of people did. What happened there?
So we were just thinking maybe there's some technical glitch, as you mentioned. So we just called the public line and we were given the numbers. And that seems like the whole story. So.